Hello, this is Bill Bateman. In this video we'll be reviewing the cost of capital for Mercury Athletic. Sometimes we know cost of capital as the discount rate or sometimes does it or the hurdle rate, and sometimes referred to as K sub W in notation, with the K sub W standing for the cost of the weighted average cost of capital, or WACC. We'll be using there are other formulas and other methods to determine the cost of capital, but today we'll be using WACC to determine our cost of capital, the weighted average cost of capital. So if you go back to the WACC formula, you'll remember that it was the cost of debt times 1 minus the tax rate times D over D plus E. So this is debt over debt plus equity, which debt plus equity represents total capital. So that is the weighting for debt. And then we take it plus K sub E, which is the cost of equity, times the weighting for equity over debt plus equity. And that will get you to the cost of capital. So as I suggested, I always like to build a table for my variables. So I have X, I have the value, and then sometimes a short description. So as you're going through the case in Mercury, we have to start finding these variables. And the first one that we come to is at the bottom, I think, of page 7 in a footnote. And sometimes these variables are hidden. But if we take a look at that, we'll see that the cost of debt is 6%. So we've got a 6% value, and it's in a footnote in the case. Maybe just a note as to where you found it. And again, I'm not 100% sure, but I think it's on page 7. Okay, the next variable that we come to looks like T, which is tax, and we know from the case it's given on there as 40%. Okay, the debt over debt plus equity, we know what the debt is. It's given in the case. And it says that they are going to use for this Mercury valuation the same debt structure that AIG is currently using. And we know from the case that it's 20%. So that's a given. Again, I think that's also on page 7. So what's equity? Okay, we've got debt at 20%, and we know that debt plus equity have to equal 100%. So with some real simple math, we know that equity, if debt is 20% of our capital structure, then equity is going to be 80. So that was a simple calculation. The next thing we need to do is find K sub E. One of the ways to figure that out is calculate it using the capital asset pricing model. And I did a video on that earlier in the semester. If you remember, the CAPM formula was equal to the risk-free rate plus beta. So we know that beta times the market risk premium. And we know that the market risk premium is the return of the market minus the risk-free rate. Okay, so in the case, again, in one of the footnotes, and I think it's earlier in the case, they describe U.S. Treasury rates, I think from 1 to 20 years, and they list the 20-year Treasury rate at 4.93. That's the risk-free rate we're going to be using, because we want to use the risk-free rate that most approximates our project. And in this case, our project is the valuation of a firm, which is going to go on forever. So 4.93%, and that's a given in the case. Our next variable that we need is the market risk premium, and this is not given in the case. But if you think back to Duff and Phelps, they have been recommending up until this year a 5% equity market risk premium. So we're going to use 5% in this example today. We know that that recommendation has since been revised by Duff and Phelps to reflect 5.5%, but in this case we're going to use 5.5%, and we'll give credit to Duff and Phelps for that. And think back to the CAPM video that was posted earlier in the term. So that leaves us with one variable to compute, and that's beta. So when we don't have a beta, as we don't have for Mercury or AIG, what we can use are other public companies or comparable companies' betas, and then estimate what Mercury's beta might be based on these set of comparable companies. So the equity beta is the beta that's usually published, and we know that we can get to an asset beta. And if you go back to the video on levering and unlevering betas, we take a beta of 2.68, and to unlever it, meaning what would the beta be without the risk of debt in it, we divide it by 1 plus the debt to equity. And using the first one as an example, 1 plus 0.299, and if you do the math, you'll find that the answer is 2.06. So we'll unlever all of these betas, and then we'll come up to, in this case, I believe they just came up to a simple average, as you can see from the formula bar up here. So we'll use that simple average. So now we have a asset beta of 1.25. What we want to convert that to is an equity beta using Mercury's debt to equity. And the way you do that is, if we divide to unlever it, to lever it back up, we multiply. So our debt to equity, based on a 20% debt to value, is 25%. So the formula is 1 plus 0.25. And if we do that math, we'll see that our beta is going to be 1.6. Okay, so we can come back over here and we can plug in our beta of 1.6, and that was calculated by levering and unlevering beta. Okay, so now we can plug these values into our CAPM formula. So we have a risk-free rate of 4.93%, and we're going to add that to our beta times our market risk premium, which is going to be 5%. And I think I listed it here as 5.5. That was an error. It should be 5%. We're going to use the old Duff and Phelps because that's when this case was written. And if we do this math, we'll find that our cost of equity is equal to 12.92%. Okay, we throw this all back into our WACC formula, if you remember from up here, and substitute all the variables. So our cost of debt, 0.06. Our tax rate is 1 minus 0.4. It's going to be 0.2 debt over equity plus the market, or the cost of equity, which we calculated at 0.1293 or 12.93%, times 0.8, and it gives us a weighted average cost of capital of 11.06%.